This video is for entertainment purposes only. Please see your financial advisor for specific advice related to your individual circumstances. Today we're going to talk about how to avoid stock market crash by using 5 ETFs. We're going to cover the first one today called SPY, and I'm going to show you 5 tips to know exactly how to spot a coming stock market crash, how to avoid it, and when to get back in. The stock market crash, of course, that's coming is caused by COVID and also a new presidency under Joe Biden with new policies and of recovery from all the stimulus spending. Unfortunately, these stock market crashes do happen at regular times throughout history. We've seen ones in the more recent past from 1987 to 2001 to 2008, and I also want to show you how you would have known that the 2020 stock market pullback when COVID first appeared was only temporary, so you could have stayed into your investments and reaped those big profits as it returned to greater heights than ever before. I'm Lynn Pearson with 60 Perfect, and thank you for being here today. We help you to get that money flowing, so please subscribe, hit the bell, and give this video a like if you're excited about learning how to avoid stock market crashes. So this is a great strategy using SPY ETF when you're in your 40s, 50s, or 60s. When you're younger, it makes more sense to put money in index fund like ETF and be able to buy it during a stock market crash because those shares will be on sale and they'll go up over time eventually, and you'll be able to reap greater profits. When we're in our 40s, 50s, or 60s, we get much more nervous about a stock market crash that could last for 5 years, 10 years, or longer. So again, I'm going to show you how to avoid that. And during this series, I'll take you into those 5 ETFs. Today, we're going to look at SPY. The SPY ETF is a great ETF to invest in if you don't have the time to sit there and track the stock market's ups or downs on a daily basis, because it has trended up over time, and I'll show that to you today too. So before we go into my computer, when I'll take you through SPY, make sure and go to Webull when this video is done and get your 4 free stocks. It's at least worth $20 for the 4 free stocks, so you get a 20% return immediately when you deposit $100. The SPY is an excellent ETF for this strategy because it is a broad market index fund and it echoes the S&P 500 index. Also, the SPY has one of the best volumes for any stock or ETF on the stock market. This means that you can easily trade in and out during a stock market crash. Also, the SPY ETF has made wide price rings over time, enabling outsized profits. So let's go into my computer and I'll show you how to work with the SPY ETF to avoid stock market crashes. First of all, I want to show you the profile for the SPY ETF in Yahoo. And you can see here that we can see the summary. We see that it has a yield, a dividend yield of 1.52% today, which is on the 21st of 2021, and that and the expense ratio, which is 0.09%, which is tiny to say the least. And the major holdings we can look at just real quick, because I told you it's a broad market ETF. That includes Apple, Microsoft, Amazon, Facebook, Tesla, Google, Berkshire Hathaway, Johnson & Johnson, JP Morgan, the largest. Now we'll actually go into the SPY ETF. I'm going to look at it from E-Trade because I have my exponential moving averages set up. So from years, I've been investing for 35 years, and after years of work on investing, I've found that I can spot stock market crashes really easily if I have the Heikin-Ashi candlestick showing, and then also, which I'll explain a little bit more about that, and also 3 moving averages. Under display in E-Trade, I click the Heikin-Ashi candlesticks, and Heikin-Ashi candlesticks, they're an excellent Japanese invention where they were able to do some complex arithmetic so that a trend shows much more consistently with the Heikin-Ashi candlestick versus just a regular candlestick. And I have a video I've made on Heikin-Ashi candlesticks so that you can help them understand how much they do improve your trading. They're really, really helpful. And then also what I do to be able to spot stock market crashes is I add 3 exponential moving averages. So I add them under studies, and you can see I have 3 added: 100-day moving average, a 25-day moving average, and a 50-day moving average. So the 25-day moving average is yellow, the 50-day moving average is lavender, and the 100-day moving average is blue. And what we look for with a stock market crash, we know it's going to be a long-term crash if the 25-day moving average breaks across the 50-day moving average and the 100-day moving average. That did not happen, and that's if we're looking at the weekly chart view. The daily chart view is really choppy, and it doesn't give you a lot of insight into the trend of the ETF over a long period of time. You don't want to be jumping in and out of your trades. You want to be able to make as much money as possible in your trades, unless you're a day trader. But if you're an investor like me, you want to be able to stay in when it's trending upward. So you could see earlier this year, since the 25-day moving average did not break over the 100-day moving average, it actually was a short-term correction. So that was a perfect time to stay in. You can see later in 2018, it also didn't break over. Same thing, you would have consistently, using this methodology, stayed in the SPY ETF, which is now at $384 per share. You can see all the way through here, you would have stayed in here until a major break way back in 2008. You can see the 25-day moving average broke over the 50-day moving average in lavender and the blue 100-day moving average. That's when you would have gotten out at about $130 per share price. And then what you do is you then look to get back in once the green Heikin-Ashi candlesticks break above the 100-day moving average. So you'd have gotten back in around $108. So gotten out again up here around 129, gotten back in at 100. So that's an opportunity to make a lot more money during the recovery and save you from losses in the downturn. So you would have been staying in all the way from getting back in at 108 to the current $384 per share. Before this, the other break was in 2001, was another major stock market break. And this happened again when the 25-day moving average broke over the 50 and then also the 100. So right here, you would have gotten out at 124 and then gotten back in once the green candlesticks, Heikin-Ashi candlesticks, went above the 100-day moving average at 100 and then stayed in from 100 to the break here at about 130. It's a great way to make profit and be able to keep your money safe. And this is a broad market index that enables you to make some good money over this in the long run. And if you compare this to other ETFs, if you look at this in the really zoom out on this thing, it's nice because the broad market index fund, it tends to really trend up over time. So you just need to stay in unless it breaks those 3 trend lines I mentioned. Excellent way to be putting in your money every month over time or when you retire, just to see your money increase. Please give this video a like and give me a comment below, and any strategy you have to avoid stock market crashes that would help the other viewers also. If you haven't yet, please subscribe and ring that bell so you get notified about the rest of this stock market protection series. And I look forward to seeing you in the next video. Bye.